What's good, y'all? So this is how I made $423 trading the NASDAQ futures today. So let's get right into the charts. So the first thing that you'll notice, looking at the charts, by the way, I'm on a 4-hour chart here, is that yesterday we did sweep the previous day's low and the previous day's liquidity from Monday. That was something that was important to note going into yesterday and also today. And after we swept this liquidity here, Monday's low, we came back up and the market tried to change from bearish to bullish. All of this order flow at the time, since for the last couple of weeks, this is all straight bearish order flow, right? And in order for the market to change to bullish order flow, we would have to get a close above these candles that swept the low, right? That would be a change of state of delivery here, right? As you can see, the market failed to do that yesterday. Going into the afternoon session, we pushed all the way up, but we ran into this 4-hour bearish fair value gap as well as a 1-hour bearish fair value gap, and the market came back and closed below. So because of that, that meant we were still holding bullish order flow. And you can see even in the overnight session, we never really were able to make a push and sustain a push above these series of down close candles that swept this low. So because of that, I was bearish going into today. And today I was looking to take my first trade at 10 a.m. Generally, I always take my first trade at 10 a.m. Why? Because I like to use the 10 a.m. power of 3 on the 4-hour candle. So this is kind of how the market looked going into 10 a.m. So if I go to an hourly time frame, I can also show you some other confluences that I liked. So if we look at the hourly chart, you can see we also had this hourly fair value gap here. So going into 10 a.m., again, using the PO3. If you don't know what the PO3 is, I'll explain it quickly. The PO3 is essentially the power of 3. It's a concept that essentially allows you to see where a candle opens, where it trades higher, where it trades lower, and where it closes, or vice versa if it's a bullish candle, where it opens, where it trades lower, where it trades higher, and then it closes. So every single candle is always going to have that on it. It's going to always have an open, a high, a low, and a close. So going into 10 a.m., I was potentially watching, because I had a bearish bias, I was potentially watching for the 10 a.m. candle to essentially trade once we opened higher into some sort of higher time frame or lower time frame premium array, right? Like a SIBI, an order block, something like that. Then trade lower and then close here, right? So that's essentially what I was watching for. So the only PD arrays that I really liked on the hourly time frame was this hourly fair value gap. So if we go to the 15-minute, we could see what other PD arrays we had here. You can see on the 15-minute, we did have this order block here, right? This was a good premium array to potentially be watching. So we can go ahead and mark that. Bearish order block, right? Which essentially is an up close candle in a series of down close candles. And then we did have this bearish order block as well, right? So I was potentially watching for us to manipulate into one of these arrays and then trade lower. And I'll show you what my confirmations are every single time I trade once I go to the lower time frame. One thing I also want to point out is that we did have news as well at that time, right? We had the ISM services PMI coming out at 10 a.m., which is red folder data. So I knew based off of that, we would get some volatility. I didn't know if the hourly candle was just going to go down immediately or if we were going to actually come up and manipulate. But in either case, I had a bearish bias. I was not looking to play longs. I was looking only for short opportunities to target resting sell side liquidity. Where's our sell side liquidity? We had yesterday's low, right? We also had this 10 a.m. low, or this 9 a.m. hourly low, right? So all this was potential sell side liquidity that I was watching for the market to target. So if we go now to a lower time frame, this is kind of what it looked like going into 10 a.m. So again, waiting until 10 a.m. opens. Now at this point, I want to identify where's all of our liquidity that we can manipulate, because in order for us to go lower, we need to go higher first. So I noticed that we had all this resting buy side here, right? that was going to potentially be a great pool of liquidity to be manipulated. And then I would also need to see a change of state of delivery after the manipulation in order to validate that I want to now enter the market short. What does that look like? I'll show you. So you can see once 10 a.m. open, we had that data come out and the market essentially just spooled 150 points immediately at 10 a.m. in 1 minute. And so now from this point, you can see what happened. We traded into that higher time frame. Remember the 15-minute order block I outlined, as well as this 15-minute order block. We were now trading into those. So now I just needed to see a change of state of delivery. Well, what is a change of state of delivery? Change of state of delivery is essentially a close below, in a bearish scenario, a close below the series of up close candles that took out the highs. So you can see the up close candles that took out these highs, this liquidity, was this 10 a.m. candle, right? So now at this point, this would need to be my change of state of delivery. So obviously you can see, even if the market came back all the way down here after sweeping these highs and we closed below this opening price, this would be an outrageous stop loss, right? Because at this point, let's say we did come back down and we closed back below here, I would now have to enter here, stop loss above this high, because that's the only way it's invalidated, right? Targeting some sort of liquidity resting below us here or something like that. And you can see even targeting a 240 point target, that's still not even a 2-to-1 risk to reward. And that's because the stop loss is just way too wide, right? That's one thing I want to point out. We're having extremely volatile market conditions right now. Pretty much over the last few weeks, specifically over the last few days, it's been extremely volatile. So it's very important that we're sizing down our positions right now and having larger targets, having wider stop losses, but larger targets, because the volatility is calling for that right now. So anyways, we swept this liquidity. I'm watching for a change of state of delivery. So at this point now, the market does come, but we don't close below there. We trade into this 1 minute BISI that we form. Actually, we hit the midpoint perfectly. So at this point, you can see the midpoint gets traded into. That's very bullish. So now I'm expecting us to take out another internal high, right? Now I'm expecting us to take out this high. Why? Because I know that we were holding the midpoint of that this 1 minute BISI that came from the data. So because of that, now I wanted to see us take out this high, which would be good because now my stop loss could potentially be reduced and my entry would be much better. And I could target now this internal opening price here, internal liquidity there. So the market does end up trading higher here. And then we do trade into back to this order block. And then we come and take out this high, right? So now at this point, once we take out this high, now, where is my change of state of delivery? Well, again, like I said, the change of state of delivery in a bearish scenario is always going to be the up close candles that takes out the highs, right? So now my change of state of delivery is here at this opening price at 10.06, right? So at this point, I still haven't taken a trade. I'm still very bearish, but I have not taken a trade. There's been no reason to go short yet, right? Just because we swept liquidity doesn't mean anything, right? Because there's still, we could very well trade higher into this 1 hour fair value gap, right, before we do go lower. So I'm not looking to predict, I'm waiting to react. So you can see from here, the market does come lower. And now I'm watching, okay, can we get a close below this up open price of this series of up close candles for that change of state of delivery to validate my short entry? You can see we come lower here, we miss it there. And then you can see we don't close, we wick below it. Right? We wick below it and we come back up almost, 50 points from this opening price. So at this point, I'm still not short. There's no reason for me to short yet. Come back down. And then we do wick below it again and ultimately get that close here. Right? So now at this point, now I can enter a short. So what I did was I put my limit order here, my stop loss above this high. Why above this high? Because this is the protected high. Why is this a protected high? Number one, we did have an SMT here with the S&P 500. So the S&P 500 did trade into its hourly CIBI, hourly fair value gap. This same one on the NASDAQ, the S&P 500 traded into it. That's one reason. The second reason this is protected is because this is the high that took, this is the price run that took out the liquidity that was resting next to it, the internal liquidity, right? So now I have this, sorry, I have this as my stop loss. But you can see this is still a 70-point stop loss. That's massive, right? And again, that's it. Depending on your account size, this is where position sizing matters, right? Because just because, I can take 5 contracts here doesn't mean I should. 5 contracts here is a $700 loss if my stop gets triggered. That's more than I'm willing to risk. So because of that, I'm only looking to take 2 contracts, right? Because that'd only be a $300 loss. Now I'm waiting for this retest to target this opening price, right? Because remember, this is the 4-hour power of 3. So now this should all be a wick on the 4-hour candle. All of this price action should be a wick that should get us back to this opening price at least. So I know at a minimum, we should be able to get this opening price hit, right? And so that's my low-hanging fruit objective. There's also a new week opening gap here that was resting here that I wasn't looking to kind of wait for the market to push through. New week opening gaps tend to be very strong, and the market tends to reverse off of them frequently. Pretty much every day at some point, a new week opening gap gets reversed. So at this point now, entering short with 2 contracts, right? On the retest, I can't show you the retest here because it only prints by candle, but you can see we get that retest to the tick here, right? So look at this. You cannot tell me the market is not algorithmic. We retest this change in state to the tick. And this is why it's important to know what your change in state is, because a lot of people would say, oh, this is the change in state, right? This 10-12 candle. It's not. And the reason it's not is because we didn't take out a high there. So this remained as our change in state of delivery because this was the only price run that took out a high. And so you see, we get the algorithmic retest there, right? Every single candle in the market means something. Nothing is random in the market. So even this wick means something, right? That was the retest telling me now, okay, we're in a sell program, right? So I didn't even care about this internal imbalance here because now I expected us to get through it to get to this opening price. So the market then trades lower here into that imbalance. Also, I want to point out there was 2 new week opening gaps. There was one here and one here. In the midpoint of any 2-week opening gaps, you have your event horizon. So that is always a good point to potentially look to take profits. So just something I want to point out. But again, I knew we should get this opening price, so I wasn't really too concerned with it. So we do, now coming into that 1020 macro, which again, a lot of people don't believe in, but I am a firm believer in it because as soon as that 1020 macro opens, we get smooth delivery right into this opening price here, right? Which we get, boom, there. That is algorithmic price delivery. And that's essentially the trade I took to today with only 2 contracts, right? So much smaller size. Had I took that with normal size, that was 100 points easily, and which would have been $1,000 trade with my normal size. But because my stop loss was so massive, I wasn't looking to really take anything that big. So from here to this opening price, that's 107 points. That would have been $1,000 with my 5 contracts. But it's all good. Again, focus on the process, not on the profits, right? So that was the trade I took today. I knew, again, because we had this new week opening gap and we had this opening price, I knew we were going to get a retracement. And so essentially what happens, let's look at our 15 minute, all right? So you can see now we've come and retested that 10 a.m. opening price. We've respected that order block. We've respected this order block. We had this SMT on with the S&P 500. So now I want to see, okay, there was another good trade opportunity. We come back again. Like I said, I knew once we hit that new week opening gap, we would come back, right? So you see, we're still holding this change in state of delivery on the 1 minute time frame. From here, we come higher, put in another high. So now we have some equal highs resting here, some liquidity resting here. So now, because I'm playing the 10 a.m., the 4-hour power of 3, all this is still manipulation. So I'm still expecting us to go lower, right? So now another great trade opportunity, right? We come back and take this high, right? Now, what is the series of up close candles that takes this high, right? And we take it into this 15-minute order block, right? It's this one. So now a change in state of delivery would be a close below this opening price, right? From the 1052 candle, a retest, and then targeting now our internal liquidity here, or potentially even the previous day low here, right? And as you can see, the market does trade lower there, right? So now you could enter here if you want it, right? Again, let's look at this stop loss. This is another huge range because we're in volatile conditions right now. So because of that, we should be sizing down. 78-point stop loss. I'm only taking that with 2 contracts, right? Targeting internal liquidity here, potentially even external liquidity here from the previous day's low, right? Which we can see how this would have played out. The market does come, we retest that perfectly, right? And then we spool lower, right? And this is still within that 1050 to 1110 London close macro, right? We come, retest this, and then trade lower, right into that new week opening gap, and the market spools lower here, right into that internal liquidity here, right? So this would have been another great trade opportunity. I do believe that this kind of chopped around a bit and then sent us lower here. And I think we're trading somewhere around here. Yeah, this is real time where we're trading at right now. So, but again, because I already took this trade, I'm one and done. I don't try to get in here and, continue to make more money. I take my trade, see my setup, get off the charts, be done for the day. So that's the setup I took today. That's the trade opportunity today. These were 2 great opportunities using that 4-hour power of 3 manipulation. And as you can see, this is currently how the 4-hour candle looks. That's all I got for y'all in this one. I will see y'all in the next one.